All right, today we are pulling back the curtain on the internal playbook that successful companies use to make big decisions and really shape their own future. We're talking about management accounting. Think of it as the secret toolkit that powers a business from the inside out. So let's jump right in. Okay, imagine this. You're trying to drive your car, but the dashboard, your speedometer, your fuel gauge, all of it, only updates once a year. It'd be completely impossible, right? You'd have absolutely no idea how fast you're going, if you're about to run out of gas. Well, that is exactly what it's like for a manager trying to run a business using only those big official annual reports. And to really get why that is, you've got to understand that accounting, well, it kind of has two very different personalities. One is all about looking back at the past, but the other, the one we're digging into today, is all about looking forward. So on one hand, you've got financial accounting. This is the official report card. It's backward-looking, it's for outsiders like investors and the government, and it has to follow a ton of very strict rules. But on the other hand, you've got management accounting. This is for the insiders, the managers themselves. It's forward-looking, it's totally flexible, and it's custom-built to help them make those critical day-to-day decisions. To put it as simply as possible, financial accounting is like that official inspection report you file away once a year. Management accounting, that's the live, dynamic dashboard you're looking at every single second to navigate the road ahead. So, what's actually in this secret toolkit? What does this live dashboard really let a manager do? Well, it all boils down to three absolutely essential functions for running any business. And those three core functions are planning, controlling, and decision-making. Management accounting is the fuel that makes every single one of these things work. Let's break them down. First up, we've got planning. This is where you take your big, ambitious goals and you turn them into concrete actions. You figure out what resources you're actually going to need. So for a pizza parlor, it's not just about a vague idea like, let's sell more pizza. Nope. It's about setting a specific target like, we're going to sell 1,000 pizzas next month, and then calculating exactly how much flour, cheese, and tomatoes we need to buy to make that a reality. Next, there's controlling. Now, I know that word sounds a little intense, but it's not about being a control freak. It's simply about monitoring your performance against the plan you just made. So at the end of the month, our pizza parlor manager looks at the real numbers. Did we actually sell those 1,000 pizzas? If we only sold 800, why? This feedback loop is what keeps the business on track. And that brings us to the big one, decision-making. This is where you have to choose between different options. So should that pizza parlor add a fancy new gourmet truffle pizza to the menu? Well, to make that call, the manager needs to know exactly how much those new ingredients will cost, what price they could charge, and how profitable it might actually be. That's a huge decision, and it's powered entirely by management accounting. Okay, so to do any of this, whether it's planning, controlling, or making decisions, you have to speak the language of business. And that language, at its core, is built on one thing: understanding your costs. And costs really come in two main flavors. You've got your direct costs. These are the ones you can easily and directly trace to a single product. For our pizza, that's the flour, the cheese, the tomatoes, no brainer. Then you have your indirect costs, which you'll also hear called overheads. These are absolutely essential, like the rent for the building or the electricity bill, but you can't really trace them back to just one single pizza. Now, when you take all those direct costs, the raw materials, the salary of the chef who makes the pizza, and any other expenses tied directly to it, and you bundle them all together, you get what's known as the prime cost. This is like the fundamental rock-bottom cost of creating your product. But here's a really, really important question for any manager. What happens to all these costs when things get super busy? Or what about when they slow down? See, not all costs behave in the same way. And this brings us to a huge distinction: variable costs versus fixed costs. Variable costs, well, they vary. They change directly with your level of activity. The more pizzas you sell, the more pizza boxes you need to buy. It's that simple. Fixed costs, on the other hand, stay the same no matter what. That monthly rent for the restaurant has to be paid whether you sell one pizza or 1,000 of them. Understanding this difference is absolutely critical. Okay, so we've got all this data on all these different types of costs. But let's be honest, a giant pile of raw numbers is pretty useless on its own. The real magic happens in how this information gets organized so managers can actually use it to make those big calls. I mean, just think about this for a second. How does a massive company with dozens of factories and departments all over the place keep track of something as simple as the cost of a single hammer bought for the factory floor? The answer is actually pretty brilliant. It's all about coding systems. Every single cost for every item in every department gets its own unique code. So a code might tell you this was for Division A2, Cost Center 002, and it was for item number 01154, which is a hammer. This basically turns the entire accounting system into a powerful search engine, letting a manager instantly find out exactly how much was spent on hammers across the whole company last month. And these codes often point to something called a cost center. The best way to think of a cost center is just as a bucket for collecting costs. That bucket could be a whole department, like marketing, or it could be something as specific as a single production machine. It's all about grouping related costs together so you can manage them and see who's responsible for them. So, let's bring this all home. This stuff is so much more than just crunching numbers in a spreadsheet. When you use it the right way, management accounting becomes a powerful, strategic weapon that helps you gain a real competitive edge. And, our source material puts it perfectly. It says management accounting is a strategic function. It's not just about reporting numbers. It's about designing the very systems that give managers the intelligence they need to make better, faster, and smarter decisions than the competition. So at the end of the day, why does any of this matter? Well, because it transforms messy, raw data into clear, useful information. It's what helps a business figure out which products are actually making money and which ones are duds. It makes sure you're putting your money and people in the right places. And maybe, most importantly, it gives leaders the tools to actively shape the future instead of just reporting on what already happened in the past. So I'll leave you with a thought. The next time you buy anything, a cup of coffee, a new phone, whatever, just take a second and think, what invisible web of direct costs, indirect costs, fixed costs, and big strategic decisions all went into setting the final price that you just paid? It's a whole world hiding there in plain sight. Thanks for digging into this with me.